Hey guys, it's WT here from the Coin Alley, and in this episode of the Coin Alley, I'll be discussing FICO Score. What is FICO Score? Well, I'm glad you asked. If you've recently applied for credit or ever applied for credit or anything credit related, there's a possibility that FICO scoring was involved in their decisioning process. I'll tell you more about FICO credit scores and the 5 factors that drives your credit score. All this coming up next. Let's get to it. And we're back. But first, if you've been enjoying my videos, I certainly would appreciate a thumbs up, and by you hitting the subscribe button. Be sure to leave a comment in the comment section. It helps keep the conversation going even after the video is over. Plus, it provides motivation and it encourages me to keep bringing you guys great content. Thank you for your support. And now for the update. So I found this great video over at the people from the FICO scoring company. I guess it's Fair Isaac. They do have a YouTube channel, and I found this great video here that explains FICO perfectly. So I'll play this brief video. You guys can go ahead and watch the video, and then after that I will go through the presentation on the different parts that makes up your FICO score.
Why do you need to understand what a FICO score is and how it's used? Because it's the credit score most commonly used by US lenders. Every day, thousands of lenders use it to more accurately understand your credit risk and make more well-informed credit granting decisions. In a nutshell, the FICO score is a number that predicts how likely you are to pay back a loan or other credit obligations in a timely fashion. The FICO scores are calculated from the data in your credit reports housed at the 3 main credit bureaus. The scores consider information about your payment history, use of available credit, plus other factors. Most of us have FICO scores for each of our credit reports. Of course, if you don't have any recently reported credit history, you won't have a FICO score. FICO scores are dynamic and can change up or down if and when your data at the credit bureaus changes. And they're calculated in real time, so they're current as of the time you or a lender requests them. FICO scores generally range from 300 to 850. The higher the score, the lower the risk for the lender. Ultimately, your FICO scores are in your hands because it's based on your credit habits as captured in your credit report. Your FICO scores do not determine whether you're approved for credit or what interest rate is assigned. That's up to the lender. But it does help the lender make that credit granting decision. So why do FICO scores matter to you? First, it makes the lending process faster and more fair. It provides you with more credit choices at competitive rates, and you'll get faster answers from lenders since the scores streamline the application process. And it applies the same set of standards to all borrowers. Finally, as you prepare to apply for a loan and view your own FICO scores, you can see what a lender sees. Your credit history all rolled up in a 3-digit number that predicts your likelihood to pay your bills on time.
So guys, in this video, we learned that a FICO score is a 3-digit number that lenders and credit card issuers use to predict how likely you are to repay them if they grant you credit. Now, the score is also used to set the interest rate that you'll pay. Now, FICO does not set the interest rate, but the lending institution or the financial institution also use the information to better understand your credit worthiness, and they use that information to determine the rate of the interest or the credit line, if it is a credit card or a loan. Now, FICO scores were introduced by Fair Isaac Corporation more than 25 years ago, and they're the most widely known credit scoring brand. Now, the term credit score and FICO are often used interchangeably, but FICO is only one type of credit score. So in this video, we'll talk about FICO credit score. So as I mentioned, there are 5 different factors that drives your credit score. Now those factors are, we have payment history, which is 35%. amounts owed, 30%, new credit, 10%, length of credit history, 15%, and credit mix, 10%. So as you can see here from this pie, that payment history is the most important aspect of the FICO score. So let's delve into the payment history aspect of the FICO scoring. Now, there are, as I mentioned, payment history is 35%. And what comprises of your payment history would be amounts that are past due, length of time past due, and number of past due items. So these are items that could potentially affect your credit score when it comes to payment history. So amount that is past due. Is it that you're past due $100 on your credit card, or you past due $1,000 on your mortgage? So as you can see, those two things can be weighed differently from a credit analyst or from a company's standpoint while they're actually looking into your credit history. Now, also the length of time that your accounts have been past due. Is it 30 days? Is it 60 days? Is it 90 days or greater? Now, the more past due that your account becomes, the more of an adverse effect it would have on your credit score. And finally, the number of past due items. Is it 1, 2, 3, or more items that are past due in your credit report? So as you can see, it is very important that you maintain a stellar or a satisfactory payment history, because by doing so, you'll be able to improve your credit score. Now, we have some time frames here in regards to past due information that is in your credit report when it comes to payment history. So this is how it's weighted. If the adverse item or the negative item in your credit report payment history is most recent 12 months, if it's within the last 12 months, then as you can see, that is weighted at a larger percentage, which is 40%. If it's the prior 12 to 24 months, it is 30%. The prior 24 to 36 months, it is 20%. The prior 36 to 48 months, it is 10%. And older than 4 years, there is no impact. So, as you can see, as the delinquent item ages, the impact is of a lesser degree. Now, let's say you have bankruptcy or late payments. Now, after 4 years, those items do not disappear from your credit report. They're no longer factored into your scoring as they age 4 years or greater. Now, most negative items in your credit report can be on your report for up to 10 years in most cases. So it's very important that you are aware of what's in your credit report. So let's say you went to apply for a mortgage, or perhaps you're trying to get a new car, and you had late payments that were more than 4 years ago. Let's say 4 years, less than 10 years. They might ask about those late payments. So it is very important to review your credit report at least once a year so you can fully understand what is in your report. Because many times a lot of individuals will say that, I don't know how many late payments I've had, or maybe I've never had a late payment. I think their understanding of late payments, it might be different than what the credit reporting agencies what their idea of late payments are, and I'll tell you exactly what is considered late payments. Now, although, as I mentioned, items older than 4 years might appear in your report, they are not weighted as much. So be aware of what's in your report so that you can speak to it. Now, regarding late payments, if you are a day or two late, don't panic. Those late payments are not reported to the credit bureau until 30 days later. Now, you want to make sure you're paying your bills on time, because if you're going to pay late, let's say your bill was due today and you didn't make a payment because of an oversight or something like that. Now, by not making your payment, you will have a late fee. If your credit card agreement does have that part of the agreement where if you miss a payment, you will have a late fee. However, the credit reporting agency will not be made aware of that late payment unless 30 days have elapsed since you've not paid that minimum due or the balance on your account. At that time, it would be reported to the credit bureau as being late. Now, the second factor in your FICO credit score is the amount owed, and this is worth 30%. So basically how this is factored in, it looks at your available credit versus your balance. So the more available credit that you have, the higher your FICO score. So we have two examples here. We have Consumer 1 and Consumer 2. Consumer 1 has a total of 7 credit cards, and the combined limit on all 7 of these cards is $40,000. Now they're carrying $10,000 in balances, and as you can see here, they have $30,000 available credits available to them. So as you can see, that's about 75% that is available in credit, and that's good. 75% available is good. Now look at consumer number 2. Consumer number 2 has 3 credit cards. The total limit of all 3 cards is $10,000, and they have $10,000 in balances. As you can see, there are zero available credit, 0% availability in credit limit. So as you can see in this example, obviously consumer number 1 would have the higher credit score, while consumer number 2 would have some kind of impact to their credit score because they have maxed out all of their cards. So as you can see, it's very important that you practice good financial management. In regards to, you need to know your credit limit on each of your credit cards, and you want to make sure that you stay within a certain percentage of your credit limit to the balance. You don't want to max out your credit cards, because as this information gets reported to the credit bureaus, this could potentially impact your credit score. All right. Next factor, length of credit history. So the length of history, this is 15%. So what is considered in this area is the time since your account's been opened, time since your account activity, so most recent account activity. And most lenders look for borrowers with long credit history. A lender will generally favor someone with 15 years credit history versus someone with 5 years. Now, both of those are good, but having shown and established payment history for 15 years is definitely much more favorable. Now, important information, it is not recommended that you close older accounts. Doing so will not increase your FICO score. One of the algorithms of your credit score is based on the age of your oldest card or oldest account, and these are best left open, even if it's not your favorite card or one that you rarely use. It is recommended that you want to keep your oldest account open. At least try to use it maybe twice a year, make it a small purchase, paying it off, and then probably putting it in the sock jar, your sock drawer. Now, many people will say that If it is your oldest account and you have an annual fee, you might want to consider closing the account. But your mileage might vary in regards to this. So I would certainly say approach this carefully and do what is best for your financial situation. Moving on, new credit, 10%. Things to consider in this area. Number of new accounts that are opened, number of credit or recent credit inquiries, and the length that they've been opened. Now, you want to be careful not to go about there and apply for a bunch of credit cards. I know there's a lot of us who are in the game. We might find a lot of great offers out there, and we are very tempted to apply for a new card every few months. Now, you want to definitely go ahead and approach this very carefully, because this does have an impact on your credit score. So this area looks at, as I mentioned, the number of new accounts that you have and also your recent inquiries. Now, credit inquiries will stay on your credit report for 24 months. And there are two types of inquiries. You have, you have a hard pull, which is an actual inquiry into your credit report. So when you apply for credit, when you're seeking credit, this is an inquiry of the lender or financial institution that actually reviewed your credit report. Now, this is whether you got approved or you got denied. Most companies will have this hard inquiry in your credit report. Now, there is something called a soft inquiry or a soft pull. This might be something that is only visible to you, the customer, or they may have just gotten just a copy of your credit score. So if it's just a copy of your credit score, this is considered a soft pull. It's not the actual report. It is just a snapshot of your credit score. Now, there are companies that will do soft inquiries. Some parties, like, depending on your employer, if you're applying for certain types of employment, they might go ahead and pull a copy of your credit report. This could be a hard inquiry or it could be a soft inquiry. It all depends on the employer. Also, if you're applying for insurance for your car, the insurance company may also inquire into your credit score. Statistically, if you have a lower credit score, you might be looked at as being a greater risk. Therefore, your insurance premiums for your car might be higher than someone who has a higher credit score who might end up paying lower premiums. Moving on, credit mix. So the credit mix is 10% as well. So overall, it's an overall mix of credit cards, mortgages, and other types of loans. Now, installment loans or installment types of credit typically increase your credit scores. So if you have auto loans, mortgages, or home equity, those type of credit items could potentially increase your score, while revolving credit can lower your score. So credit cards and open-end lines of credits. And the reason why the installment type loans can increase your credit score is because these items generally, they do not increase in the amount owed. So like your mortgage, your auto loans, etc., you will pay down those obligations until they get to a zero balance. So they have a different risk involved as with your revolving credit cards, which our credit card is consistently, you increase the balance, you pay it down, you can use it again. But with an auto loan or a mortgage, once you pay it to zero, you cannot increase your exposure to that company once again. Now, guys, I know this is a lot of information, and I know that there is a lot of information out there regarding FICO and credit. I wanted to kind of compress the information here in this presentation and provide that information to you guys. Now, if you're looking for a free copy of your credit report, there is a website where you can obtain this information. You can go to annualcreditreport.com, and each year you can get a copy of your credit report from each of the credit reporting agencies that is out there. Now, you can also get copies of your credit report from other entities. You have NerdWallet, you have Credit Karma, Credit Sesame. There is a plethora of these companies out there. Some of these entities, you can obtain a copy of your report for free. Others may have a charge. But this website here, the annualcreditreport.com, you are entitled to, as I mentioned, a copy of your credit report each year from each of the credit bureaus. Now, if you are ever denied credit, you are also eligible to receive a copy of the credit report from the agency that your credit was accessed from. So if you did apply for a card and they used TransUnion and you were not approved, then yes, you are eligible to get a free copy of your TransUnion credit report. All right, guys, this is it for this video. I know it ran a bit longer than I had anticipated, but I hope you did find the information to be of great use, very helpful. As always, please give me a thumbs up. If you're new to the channel, certainly consider subscribing. Also, click the notification bell so whenever I do post new content, new videos, you'll be one of the first to be notified. All right, guys, until our next video, take care of yourself and, of course, each other.